Larry, thank you so much. Your tweet storm really generated a lot of buzz over Twitter. So based on that, how did you get to this conclusion? What is a black hole monetary economics?
The black hole in astronomy is a star that light can't get out of. And loosely, a black hole in monetary economics is when the interest rate hits zero and it absorbs the economic energy, and the economic energy can't get out. And the difficulty is that there doesn't seem to be much that the central bank in Japan has been able to do for a very long time now to get it in nominal GDP, its inflation going. Europe is headed into recession starting at zero interest rates. And in America, when we have a recession, the interest rate usually has to be reduced by 500 basis points, or it has to be reduced to 300 basis points below the neutral rate in order to get the economy going. And given where we're starting, there seems to be no real room to get anything close to that.
Yeah.
And so my conclusion is that we got to think much harder for economic stabilization about mechanisms that involve spurring demand directly. Those mechanisms might involve the government deciding to run budget deficits. They might involve some kind of change in transfer programs or expansion of Social Security. They might involve efforts to mobilize more infrastructure funding.
Yeah.
There are a variety of possibilities, but I think we have to think outside the box. And when I see central banks debating when they're how often they're going to have their press conferences or in what form they're going to offer their projections, it just seems short of the potential problem that we face. And
right.
You don't need to plan for small contingencies. You need to plan for big contingencies.
Well, Larry, and to that point, on Twitter, you had one chart that really echoes what you're just saying, and it takes a look at, say, other periods of easing, say, early 90s, 2001, 2008, and just how much the Fed was able to cut, as you mentioned, up towards of 500, 800 basis points, and how we just don't have that kind of room now. It seems like what you're saying is that the answer is, in essence, modern monetary theory, where you just basically borrow a lot of money to have a lot of fiscal stimulus. Is that true?
I think that things very much in that direction are going to be necessary if we are in a recession or if we get too close to a recession. Where I part company with modern monetary theory is in believing that it somehow would be good to never change interest rates, to believe that somehow we can do it all always with zero interest money, and to believe that nothing about budget sustainability matters in any circumstance. But so I think there are some real problems with the breadth of applicability that the modern monetary theorists take it.
Mm-hmm.
But I do think there's a core of validity. You know, by the way, it goes back way before modern monetary theory to an idea called functional finance. I think there is a core validity to the idea that's contrary to what most economic students have been taught, that monetary policy can't always achieve stabilization even of what we think of as monetary quantities, like the total dollar value of the GDP or the rate of inflation. And I think that's an important lesson that we're going to have to take on board. I've also become, I think, another traditional doctrine that I had in my thinking until fairly recently given lots of weight to. The old idea of monetary policy is sometimes pushing on a string. is something we're going to need to reflect in our thinking. That's not saying that it's not better in a somewhat risky situation to err on the side of dovishness. That's what I've been arguing for a long time, and I think that's right, and I still believe it. I think, though, that we need to be directing more focus towards non-monetary policies that can stimulate demand. And unfortunately, central banks, understandably enough, are reluctant to acknowledge the limitations of what they're able to do, and that keeps the debate further from the fiscal policies that are necessary.